Hello traders, it's Thursday, February the 6th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give your FX market wrap-up for the past 24 hours of trading, and an outlook for what we can expect in the 24 hours ahead. Now, this past 24 hours is a continuation of the consolidation period that we've seen pretty much this entire week, but the next 24 and really 48 hours are looking a lot more interesting. Not only will we see a number of very key pieces of event risk, we're likely to see a development for many of these markets, not just capital markets, but also FX, and it will have its foundations in data, but more so it's going to be just a buildup of pressure in these underlying fundamental themes. What are these themes? What are these indicators? We're going to talk about them today. So the two things that I do want us to keep a very close eye on, even though we will be distracted by data that takes our focus elsewhere, is the US dollar. All right, you can see this is working on this consistent rising trend channel that we've began back here at the beginning, really, of November of last year, and the S&P 500, which is consolidating at the floor of another major level of support, this rising trend line that began at the beginning of 2013. So these two benchmarks on opposite ends, traditionally of the risk spectrum, are both just grazing the ground, just dragging their bellies across the support levels that we are seeing here. Seeing one break is likely to instigate a opposite move on the other side. Now, we have seen actually a pretty strong correlation between these over the past 18 or so months, but that is unlikely to persist as we start to see a more concerted risk-based move. I cannot stress enough how important risk trends are and how fundamentally skewed the performance of the markets would be whether we see a risk on or risk off element. Risk on, how much upside potential is there? I know a lot of people are making a significant thing out of the fact that we've had a pullback here from the S&P 500, but what does this pullback really measure up to? All right. Essentially 6% and a record-breaking run to record highs. All right, we put it into context, it is barely a blip on this radar. All right, there is so much more potential to the downside and unwinding, especially through these leveraged and overtly exposed markets and high-risk, high-yield assets. All right, there's so much exposure that a move to the downside, breaking through people's complacency and optimism, would be a very, very destructive force in the capital markets. On the opposite side, yes, you do have a pretty long-term bull trend here for risk trends, but we know how slow the climb would be if we were to try to persist, especially now after another correction where it's going to take some time before people once again trust it, and they will never fully become as engaged as they have been in the past, because we are moving further and further into record high territory, and that is not bargain territory. All right, so we're going to keep a close eye on these. I think that if we do see the S&P 500 break this floor at around 1745, 1740, the potential to the downside would be quite significant, and we would see quickly that the US dollar would regain traction and likely on this floor. Of course, the timing depends here. This, if you don't have a rebound in risk trends for the S&P 500, that could be one of the few saving graces the dollar has before it starts to break down here. We are seeing the dollar at some noteworthy support, not just on this aggregate basis, but Euro USD back to the former support, now new resistance. You have pound dollar, which is starting to hold this floor here at around 162.50. Dollar yen starting to fade into the downside, and even the Aussie dollar, one of the most troubled currencies out there, is gaining not just against the US dollar, but it is gaining, and it is gaining also against the US dollar. One of the big problems with the US dollar is that a lot of its buoyancy through the past months, all right, the fact that we've had this strength from the US dollar, despite the fact that the S&P 500 was rising, has a lot to do with the fact that we have the market focusing in on taper, all right, those taper expectations. Now, the problem is we've seen two tapers, all right. These two red lines here indicate the time frames for the tapers. You see it on the dollar chart as well. And what has the US dollar done since that first December 18th taper, that faithful day? Well, on a percentage change basis, the Dow Jones FXCM Dollar Index is actually virtually unchanged. Right? So it has not conferred much benefit to the greenback. There's a couple of reasons for this. One, that the markets were certainly pricing this outcome potentially in well ahead of time. Furthermore, we haven't seen the positive net effects of that taper. All right, the taper is really encouraging because it does lift shorter term rates, and you start to see a more competitive forecast for the US dollar. Interest rates and the forecast for interest rates are what really drive currencies. It's one of the fundamental elements of pricing a currency. Now, we have seen the 12-month interest rate forecast for the US dollar significantly increase. You can see here from the overnight index swaps, 12-month interest rate forecast is actually pricing in a rate hike sometime before February of 2015. So we do have an improved outlook. However, we probably need a little bit more. We don't need just interest rate forecasts. We need to start to see the market yield, the actual yields that we have in these markets that provide some level of carry, or at least make the dollar too expensive to play the role of funding currency, to pick up. Right? In the meantime, that relationship to the risk theme, even that is starting to come apart. All right. We have been, the dollar has been enjoying that positive correlation to the FX volatility index, or just the S&P 500 if you use that as your risk measure. But recently, the FX volatility index has capped itself at below 9%, as you can see here. If we want to see a significant rally from the US dollar, we really need to cater towards its safe haven status. We need to have something that is driving the sentiment forward. All right. And a risk trend bounce would be, or risk aversion, in other words, would be the best catalyst for achieving that. Now, you see it here on a relative basis, but I do want to put it in statistical form. I measured the 20-day rolling correlation between the US dollar and the FX volatility index, and as you can see, when it's close to 1, that means it is highly positive. All right, that means that they move together in the same direction and essentially in lockstep. When it's near -1, they are moving in opposite directions, nearly in lockstep. Unusual. That really only happens when we have unique pullbacks for the dollar, or a rally in the dollar that is not meant to last. All right, and really it's only the pullbacks that have leveled up to that, and that's because it's a bias towards risk on versus risk off. But as you can see in the midpoint at 0, the relationship completely starts to depart from each other. All right, there is no correlation; it erodes, and that is what we need to see corrected, because otherwise we're going to have to look towards monetary policy, actually something that can drive forward taper speculation. Now, of course, most of us know on Friday we have some very important data. The U.S. employment data for January, certainly a market mover, but is there really a doubt of the Fed's taper? Well, we've heard policy officials repeatedly say that they think that this is the path, continue taper, 10 billion pace. In fact, this past session we had 2 central bankers come out and suggest that they're expecting a continuation. Lockhart said the default, quote-unquote, default mode is $10 billion taper. And we even had Plosser who said that, whose updated growth forecasts suggested that he thinks that there is a need to accelerate the taper. That's all well and good, but we need it to impact the market. Potentially this data can put us all into the same frame of mind, and speculators all into the same bearing for the market. So we'll see if that's the case. Another element, and this is my segue, another element for really helping out the dollar potentially, or hurting it, depending on how it comes out, is relative monetary policy. Not just what the Fed is doing in tapering and interest rates in the United States, but what the other central banks are doing, what their interest rates are, and what their outlook is. All right, perfect time for this, because in the upcoming session we have 2 very critical pieces of event risk, the BoE and ECB rate decisions. All right, these are going to be very important pieces of data. Now, I covered in depth the ECB rate decision in today's strategy video. You can check that out, and I go through the different scenarios for them. But both of these rate decisions actually carry a lot of influence. The Bank of England rate decision we've seen a recent pullback from the pound, and for good reason. The pound has been driven for 6-7 months higher on the expectation that a rebound in economic activity would necessarily lead to a Bank of England rate hike. All right. Now, it's not necessarily that this is a rate hike that is the big issue. It's that the market is pricing it in sometime within this year, whereas the Bank of England has been very adamant that they are not going to move until 2015. All right. Whether or not the central bank is adamant, though, it really all comes down to speculation. If traders doubt the Bank of England's resilience, they will keep that pound elevated. All right. This is once again a reflection of what the market sentiment is, how a market can have a bias, and how conditions can look like they make absolutely no sense, and it really doesn't matter. If the market tells us orange is purple, guess what? It's purple. There's no reason to trade against it. You have to make sure that you're trading with what the market thinks. All right, this is you're playing not necessarily fundamentals. You're not playing what looks right or what you think is right. We're playing the biases and expectations of the masses. And sometimes it can make little to no sense. But if that's the kind of path they're on, that's what we have to follow. That's where we're going to be able to exploit those inefficiencies. So with the Bank of England rate decision, are we necessarily going to get any kind of meaningful changes from the central bank? It's unlikely. All right. They will definitely be making some very substantive changes to their policy guidance very soon. In fact, next week, next Wednesday. But as of this Bank of England rate decision here, they're not really looking at much of an option to do so. Why? Because traditionally the Bank of England, when it makes no changes to monetary policy, does not issue a meaningful update in its statement. If they were to make a statement change, which if there were a need or a time to do so, it would probably be now, but if they were to do so, it would generate a lot of volatility. All right? And if they were to do so, it would not be to tell the market that they are going to, we were wrong in our forward guidance. We shouldn't have put a 7%, or we put out a 7% target for unemployment as our catalyst for interest rate hikes. And yes, it's happened too quickly. You know what? We're going to bend to this. We're going to have to hike rates sooner. All right? They wouldn't do that. Why? Because it would generate massive amounts of volatility. It would lead probably UK equities to a pretty stark decline because of the higher borrowing costs. And it would also lead to a very sharp rise in the British pound, which, though they're not necessarily targeting the exchange rates, would be a certain pain. All right, that would be a discouraging outcome, and they would avoid that kind of impact. Now, alternatively, they could also give us an unexpected update to the opposite effect, saying that they acknowledge that the forward guidance has been, or the markets have, or the economy and the markets have neared the forward guidance targets that they had set out. But regardless of that, they're not changing. All right. If that's the reinforcement they're giving and suggesting that they're going to potentially change their forward guidance, which is something that BoE Governor Carney suggested last week, then that can be just a further impetus for the sterling to drop off. All right. So we have a fundamental bias here, the scenario bias, where it's more likely to be a surprise for a sterling decline. All right. So I'm not saying it's a high probability that they come out and say, you know what, we are maintaining our stimulus approach. We're not going to hike rates in 2014, and instead we're going to change our forecasts, all right, or our forward guidance. That's more likely to come out next week. But if they do, all right, that will certainly take out that 162.50 floor. If you don't trade during this period, this is probably a good time to either, if you have a position on, to trim up your stops. If you are looking for an entry, then maybe you should be awake during this event risk. Even though it's a relatively low probability, the opportunity cost would be very high in not watching it. Now, of course, the pound dollar isn't the only pair that we could be looking at. We can definitely take a look at the euro pound, but I think that the euro is going to have a lot more influence over this pair than the pound will. The pound yen is always going to be influential, though just like the pound dollar, it has a greater influence or greater sensitivity to risk trends. If the pound starts to drop off in general because of a surprise, don't expect the pound yen to really keep dropping off unless risk aversion kicks in, because risk aversion, if it's not moving anywhere, can act as an anchor as much as it can act as a proactive driver. The pound Kiwi and the pound Aussie are a little bit more effective as currency pairs with momentum. If the pound is offering up some level of disappointment, pound Aussie's already made its break. Potential continuation here is the Australian dollar is firming across the board. Really, interest rate expectations have significantly improved. They're not really in full rate hike territory, but the 12-month forecast is pricing in 16 basis points worth of hikes over that period, so it's starting to pick up. Now, if the pound, on the other hand, is stabilizing, take a look at the pound Kiwi. We've been tracking this pattern for a long time. All right, and this rising wedge, we are not very far off the floor of this rising wedge, and we'll see what we can have from this range. Now, of course, the far more interesting central bank rate decision that's coming up is going to be the ECB rate decision. All right. As I said, I covered this in detail in today's strategy video, but there is good reason to expect that perhaps not this policy meeting, but in one of the upcoming policy meetings, and good probability here too, that the ECB actually decides to up the stimulus effort, all right, as a preemptive measure. Why would they need to do this? Well, there are certainly concerns arising out of the Eurozone that include a reduction in liquidity buffer. All right, we have seen the liquidity in the market that is out there for the financial sector has significantly dropped off, as the ECB's balance sheet has similarly dropped off. In fact, when we look at the ECB balance sheet, it has dropped nearly 30%. 30% since its peak in June 2012. All right. That, in turn, leads to a rise in interest rates, because the cost of funding, it becomes a little bit, it becomes more difficult to find and thereby more expensive, and those higher lending costs are passed on to the economy, and it becomes a more difficult place to operate in. And we already know that a lot of these countries are already struggling. Furthermore, we have ongoing stress tests for the banking sector. We have recent financial uncertainties that have popped up. That's why the IONA actually had a severe couple days of jump. And that is uncertainty and risk, especially with Ireland out of its own rescue program and Portugal soon to leave, and both of them not wanting precautionary lending lines. Furthermore, you see that there has been a massive inflow of capital into Spanish and Italian and other periphery government bonds, which has pushed the yields. The demand has really risen, and yields are at record lows. Not because the conditions look particularly good, but because this is a lot of speculative inflow. What happens when volatility picks up? That speculative inflow, just like the leveraged equity position or leveraged anything position, is really going to start to unwind, and that will create funding pressure in these markets. These are economic figures. These are important fiscal figures. They're not something you will see volatility in. So a preemptive measure is a reasonable expectation. Maybe not this time, but within the next few meetings. All right, so this is the probability scale. I go over it in detail in the other video, but holding policy is the more likely outcome. The outcome for the euro would be somewhat bullish. How bullish? It remains to be seen, but the market is pricing it in, which is what we see in the yield expectations between the ECB and the Fed here. You can see how differential this bearing is. So if we see a hold, some of this speculation might unwind, and you might see the Euro USD jump. However, the need for stimulus and the need for stability in the region is exceptionally high, to the point that there's a higher probability that they do maybe an experimental rate cut They do have a little bit more room to move on the benchmark lending rate, though not much. And they have been discussing the possibility of turning the deposit rate to a negative, which would be really difficult to measure, especially on the scale of the ECB. But that's a possibility as well. A new stimulus outcome, like an LTRO-like program, would be euro bearish, just like a rate cut would be. But this one is probably going to be more effective from a financial stability perspective. So it might actually be the preferred route. Of course, the market is much more into a rate cut. We've seen a lot more speculation surrounding, a lot more conversation surrounding it. There's also discussions of potentially the first move being the sterilized government bonds that the ECB had bought. They might stop sterilizing those. So it is an outright approximately 175 billion euro flooded into the system for the banking sector. That would be still a stimulus-based program, and subsequently it would lower interest rates and push back expectations of a hawkish turn from the ECB, and ultimately it could hurt the euro. All right. I actually think since a combination of rate cut and stimulus is the fourth probability, a fourth scenario there, 3 out of the 4 scenarios look like they end with some kind of easing, and the likely outcome of that, especially against a Fed taper, is more bearish. Furthermore, the risk considerations, upside on the Euro USD, the Euro USD is not very positively correlated to risk on. However, risk aversion is more likely to hurt the euro, as its fragile condition in terms of fundamental appeal is pitted against the dollar's appeal as a safe haven. So this has a much better fundamental bearing to the downside. I've been short the Euro USD since it made its turn here. I actually was trailed out at my trailed stop at 135 pips, so I booked the second half of that trade. That was a good first round. I actually decided I wanted to get back in short. The size is smaller, all right. The stop is a little bit wider. I believe I have it 80 or 90 pips, and that's because I don't want to take on too much risk, because this is very event particular. All right, now if it does break this floor, about 134.75, and it's breaking that floor because of a more dovish ECB, then I will add. This has good potential, though, because it has more of the fundamental themes in its favor, though the highest probability outcome is probably going to be something of a bullish push. You also have to, and this is why we were talking about it, keep in mind the dollar is a component to this factor as well, and it has been struggling at this channel floor, and we have non-farm payrolls on Friday. So there's some complications to this. There definitely is, but it's something that has an interesting fundamental lean to it. Now, other euro-based pairs, I said the euro-pound would be a good one for this event risk, and between the ECB and BoE, the ECB is going to be the more market mover. We'll see what happens with the ECB. It's likely to give this direction, whereas next Wednesday, when the Bank of England releases its quarterly inflation report, that's when the pound takes over. But we have plenty of time between now and then to give this some market movement. We can also take a look at the Euro Yen, but once again, risk trends is extremely important here. Euro Aussie and Euro Kiwi. Looks a lot like the Pound Aussie, Pound Kiwi. All right, same circumstances. They're in different technical phases, so you have to be a little bit careful about what your assumptions are here. I would also like to point out not just these very particular pieces of event risk. There have been some really remarkable developments from pairs that we don't typically look at. The dollar CAD, you can see, is starting to place a head and shoulders pattern, and it's doing so under this 50% fib retracement of the big 2009 peak high down to the 2000 low. And that is some conflicting technical views. We'll see what happens of this, but this is very much a outlook for the US dollar. Aussie CAD, all right, is pressing technical levels, and there's pretty consistent technical levels, but there are short-term breakouts that are happening here. This gives good short-term trading if you're into that. Aussie Kiwi is still running on bullish bars. This is a very consistent move in terms of the consecutive bars to the upside. It's a good opportunity to use that consecutive bar indicator that you can get for free download, but it gives you a good sense of how persistent this is, and potentially if it comes with a sense of being overbought. All right, but this has good fundamental bearing, especially because the Kiwi is significantly appreciated for its high yield outlook. Aussie dollar has none of that, but it's starting to improve, as we said before. And the last two things I want to look at are falling outside of our traditional view, but it's gold. And gold had a huge intraday rally because of the ADP figure. In fact, it rallied about 1.3%, but came back immediately. The dollar didn't make that move. The S&P 500 futures didn't make that move. All right, gold is antsy. It wants a breakout. It did technically break out this short-term wedge pattern here, but as you can see, fundamentals. You need that follow-through. You need a reason for follow-through, and that just didn't give it. And the last thing, keep your eyes on these emerging markets. They are very sensitive to risk trends. They can give you a preemptive reading on sentiment building up, swelling towards risk appetite, risk aversion. But the dollar MEX is another really good one. Dollar peso is very clear in its technical bearings. All right, we've had some great swings. I know this is a favored emerging market currency for Jamie. We'll see if this one gives us as much a guideline as the ZAR, the South African rand, or perhaps the Argentine peso, which we really can't trade. All right, but keep your eyes on these various market classes. All right, they work in conjunction, especially when we're talking about big fundamental themes like risk trends. All right, we'll wrap it up there, and we'll give you a synopsis of how the central bank decisions had come out, and we'll talk about the non-farm payrolls outlook tomorrow.